What a stretch it's been. The markets have been up and down and up and down. This motion that's making a lot of investors seasick. Well, today I want to talk about one of my favorite strategies to score big in an environment like this, as well as it allows you to wait out all this near-term market volatility. Better yet, it only costs you around $4. Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. If you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Okay, so a lot of newer traders fall in love with short-term options, weeklies, monthlies, all that kind of stuff. You can do all sorts of strangles and straddles. The action is fast-paced with plenty of highs and lows, enough to keep day traders hooked for a very long time. But there's another option strategy that's less volatile, cheaper than owning shares of the underlying company, and offer a ton of upside. Long-term equity anticipation securities, or LEAPS. So LEAPS are great when you know an opportunity is severely undervalued, but there's probably a year, two, or more before that rebound completely materializes, and it's probably going to be a choppy couple of years. LEAPS are just, long dated options. You can see them every time you pull up an options trade. Those are those ones that are the furthest out. So what you have is that massive upside that options allow, as well as being able to take a stake in a company for the long run at a fraction of the overall share price. I use this approach for my readers over the past 18 months on companies like Garmin, Square, ExxonMobil, and a bunch of others. So it's really great to target any sort of undervalued sector or company. And right now, one of those industries that I feel is completely undervalued is travel, especially when we look at its long-term outlook. Now, I don't think any of us believe airlines won't lift off again, but we are in a stretch where we thought the pandemic would be in the rear view, right? We thought COVID would be this vanquished enemy, like choking on our chemtrails as we blasted La Vida Loca and went about our jet set lifestyles. Cue sad trombone. That didn't happen. Here's the deal though. The International Air Transport Association forecasts air travel won't return to pre-pandemic levels until 2023. We are seeing some life here, but we know this is a very long runway. That means with airline stocks at these depressed levels, as the Jets ETF is sold off this year, there's a number of opportunities that we can look at. So I want to take one of my favorites, American Airlines, and use this as an example. Shares of American are up almost 50% from their 52-week lows, which were set last October, but they're down, 25% from their 52-week highs, right? It's all part of this really tough spell for airlines because no one can pinpoint when this true recovery is going to take place. And every week we seem to have these new Delta variant headlines that keep pressure on this sector. But we know a recovery is going to happen eventually. That's the perfect setup to use LEAPS, right? This year, American is projected to see revenue jump 76% to more than $30.5 billion. It'll then gain another 39% in 2022 and then continue higher from there into 2023. I do like to point out that the 2022 figure for American is equal to its 2017 revenue. And during that time, American shares traded for more than $40 on average. So it's double from where they are right now. Not to mention, this is a situation that I really like using, price to sales, or we can use market cap to revenue. American's market cap is a mere $13 billion. That's way below the projected revenue we're supposed to see this year and next year. So that means that's also a great position for upside. So I'm in this position that I know airlines are going to recover, that travel is going to return. I could go out and I could pay $20 for American shares with this long-term outlook and view, right? 100 shares would cost me $2,000. And if shares go to $40 like they did in 2017 over the next year and a half, hey, I've scored a double. But I could turbocharge all of this and take the LEAPS route. For example, in January 2023, I've got in the money $20 calls for American Airlines trading for roughly $4. Now, one contract representing 100 shares would cost me approximately $400. Now, since my cost is lower than buying regular shares, I can increase my position size by fivefold. On my 5 contracts representing 500 shares, $2,000. Better yet, my potential upside here is a lot higher than owning shares. Let's say, for example, shares only go to $30 by January 2023. My gain just owning the shares is 50%, but my gain on those January 2023 $20 leaps would be 150% because I bought them for $4. They wound up being worth $10 in the money. That's the power of this strategy and why I believe every retail investor should be using it. All the professionals already do. This is a perfect opportunity to wait out volatility on an industry that you know is going to rebound, and better yet, it only costs you around $4. Well, I'm Matthew Carr, Chief Trend Strategist for the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns.